Okay. Good afternoon, everyone. On behalf of Women and Young Members Excellent Committee of ICAI, I, CA Kshama Valavalkar, extend a warm welcome to all of you to the Sky High Symposium series. It's a platform created by the committee to share technical updates, enhance non-technical skills, and encourage our own members to confidently express themselves in public forums. This initiative aims to empower and inspire our members to step forward and make most of their abilities. Chairperson of BIMAC is CA Preeti Savlaji, who is also chairperson of the Sustainability Reporting Standard Board and vice chairperson of Valuation Standard Board for the year 2023-24. Vice chairperson of BIMAC is CA Abhay Jhajerji, who is also chairman of Commercial Law, Economic Advisory, and NPO Cooperative and vice chairman of Accounting Standards Board. This Wednesday program series has been thoughtfully designed to nurture the growth and development of our cherished women and young entrepreneurs. Sky High Symposium is not just about technical updates, but it is also a platform to cultivate non-technical skills and empower our members to shine confidently on this public stage. Today's session holds the promise of enlightenment as we explore the realm of GST. The topic for the day is the first part actually, GST Health Check Tracker, decoding easy steps to ensure GST. And a very young and vibrant and cheerful speaker we have for the session, that is CA Sonal Jain. I'll have a small introduction of her and then the dais is open for her. CA Sonal Jain. She is a partner in Mistry and Shah LLP, a chartered account firm in India. Throughout her academic career, she was a topper and has secured 24th All India rank in the CA final examination. She was a gold medalist in a Bachelor of Commerce and also a university topper in Masters. Her expertise area of practice are indirect taxation, system implementation, FEMA, customs, and FTP. She is an active speaker on topics related to tally and system implementation, FTP, GST, custom, and has taken more than 100 sessions in various professional forums. She has been awarded with the Young Achievers Award in CA Women Achiever Award 2018 by ICAI Ahmedabad. She has been chairperson of Women Empowerment Committee of CA Association. Recently, she has been awarded with CA Women of the Year Award by ICAI under Women Excellence Award 2023, the current year. So now, Sonal Jain, towards you. Thank you.
Thank you, ma'am, for such a warm introduction. So without waiting much, let me start with the session. I'll just share my presentation. Is presentation visible? My voice and presentation both is properly visible?
Yes, Sonal.
Okay. So friends, as the topic suggested, today's topic is GST Health Check Tracker, decoding the easy steps to ensure GST compliance. So frankly speaking, the purpose of taking this topic is that we are already in the month of January and very soon March will come and we'll be closing the books of account for the year 23-24. So this tracker will be like a compliance tracker for you all while doing the statutory audit as well as GST audit for your clients. Today, whatever points we'll be discussing are such points which will be eye-opener for many of us because These points will help you to ensure compliance for your clients. Along with this, it will also help that how you can have checkpoints wherein there can be easy and auto GST compliance. So, first thing, we will cover that why this tracker is taken, what points it covers, and I have prepared a detailed checklist which covers 14 points, 40 points. So frankly speaking, if we walk through all these 40 points, for any company, like whichever nature of industry it is there, if these 40 points are compliance, we will be covering almost 90 to 95% of compliance. So if you are delegating your work to any team in your office, and if you're giving this tracker to that team, it becomes very easier for you, and this will make your work more systematic and system driven. See, my objective of bringing this tracker is, we all know that nowadays in GST there are lots of notices coming, especially notices are pertaining to 17, 18, 18, 19. So if I see that during the year 17, 18, if I would have implemented my work through this tracker, I would have saved lots of time today. Because today, while opening the records of 17, 18, I need to recall all the transactions of 17, 18 for that client. But this tracker is compiled in such a way that it is a single document containing all the GST related information for that particular year. So this tracker will be very much useful if there is any future litigation. Secondly, being an auditor, we ensure to keep the audit documentation for our work. So this Excel tracker will work as an audit documentation. Third thing, though we all remember everything related to law, but what happens as a human nature, we tend to forget many things. And many times it is possible that for particular type of industry, we need to involve additional point. So this tracker ensure to have a 360-degree coverage from all the statutory aspect in context to GST law. Fourth and the most important thing, this tracker can be part of your planning execution, and it will also help in monitoring the work related to GST. Now we'll move directly to the tracker. That is the main document of today's session, and that will cover all the aspects related to today's session. I hope Excel file is visible to all of you. And in case while during the session, if anyone is having any question, you can write down in the question answer point. We will be taking that question at the end of the session. So friends, this Excel tracker is like a single document covering all the aspect of GST. As far as my knowledge, whatever is applicable to any client, maybe in any nature, in totality, all the points are covered in this file. So for example, generally, whenever we do audit of any company, say for year 23-24, I'm doing audit of any company. The first thing which as an assessee, as a auditor, I should ensure is that I need to take the GST registration of that client and need to validate his all the registration are mentioned there or not. So generally what happens, this point is very simple, but being an auditor, we overlook this point considering that registration details are always common. It is right from the inception. But what happens nowadays, there are very many a time it happens that every month GST officer comes for visit to client place. There are random audits from the department, and they have a surprise check wherein they see whether godowns are added, premises are added, contact details pertain to the authorized person or not. So as a part of auditor, while we are doing our monthly audits or 6 monthly audit or a statutory audit, the first thing we should ensure is that we need to ensure whether GST registration of client is updated in context to current thing or not. Because many times what happens, client himself adds certain premises and he forget to convey us. But if we are ourselves asking him that, see, this is your registration, it is having this detail, is there any change in this detail? Then during that time, if there are any changes, we being an auditor can get the details updated. And this will help assess in various aspects. Recently, in one of my clients, what I faced that one of the premises was not added. So due to that, there were various purchases for that premises and the officer disallowed the input credit for that premises on the ground that the premises is not added in GST registration. So it is very necessary to ensure that registration is updated or not. Moreover, registration updation is also important from angle to GST refund. For example, your client is an exporter, and if IEC detail is not mentioned in GST registration, there are possible that his GST is not getting mapped with the custom portal or the DGFT portal, and refund can get stopped. So these things are very basic, but this has to be part of your compliance tracker. And if it is part of your compliance tracker, whosoever from your office is going for the GST audit, he will ensure that whether this point is validated or not. The second thing is that, see, this tracker has almost 40 points. There might be many points which you will feel that they are so basic point. What is the purpose to discuss them? But my objective to prepare this tracker is such a way that it should cover all 360-degree aspect. So it will cover all types of point, very basic point, very detailed point, very different point. Looking about the second point, it is very basic point. It simply contains that whether sales is reconciled with GSTR 1 and GSTR 3B. So this being an auditor, we always ensure that our sales is getting matched with GSTR 1 and GSTR 3B. The third point is again important. The third point is in context to an export. So if your client is an exporter, you need to ensure that whether his exports are supported with LUT and if LUT is not taken, and if that export is against with payment, then you need to ensure whether again that GST with payment, he has received the GST refund or not. So for LUT, you can simply tell your team that if this client is having exports, take the LUT document as a supporting document. Because see, if LUT is not there, then that exports will not be considered, that client will not be allowed to take export benefit. Third thing is that if your client is a service exporter, then in that case, you need to ensure whether he is having FIRC or BRC for that exports or not. So there are two types of exports. One is goods export and second is service exports. For goods exports, whenever goods goes out of the Indian custom border, automatically after closure of transaction, the assessee receives the BRC, that is bank realization certificate. That becomes a genuine proof for that export. But in case of services, as services are going through online medium, through digital platform, there is no document which suffice that services are rendered. The only proof that ensure that your services are genuine export, there are two proofs. That is FIRC, as second is BRC. Now, what is FIRC? FIRC stands for Foreign Inward Remittance Certificate. So say your client is a web developer and he is rendering services outside India, stay in USA and rendering the services of website development there. Then you being his auditor need to ensure that for whatever web development services he is giving outside India, whether he is getting foreign inward remittance certificate for any foreign realization from outside India. This FIRC you get from the bank. And as an auditor, you need to check whether the purpose code mentioned in that FIRC belongs to that services or not. And secondly, if that services falls in the category of requirement of soft tax of RBI, then for those FIRC, that assessee need to file the soft tax and get the bank realization certificate issued from bank. So this is a very gray area and many of the chartered accountants are not aware of this aspect, that if a client services falls in the requirement of soft tax compliance, then only FIRC is not a proof for foreign realization. That assessee need to even get the BRC, and both FIRC and BRC becomes mandatory thing to ensure whether that service export is a genuine service exports or not. So this point, keeping this point is in tracker is that if your client is a service exporter, then you will always ensure that whether this point is getting complied or not. check the FIRC, check the BRC. After getting checked, then only this point get fulfilled. Uh, there are various services which falls under requirement of soft tax, and there are certain services wherein only FIRC gets sufficed. But in any scenario, either document is mandatory to ensure the foreign remittance. See, for export, one of the conditions under GST is that there has to be foreign inward remittance realization certificate. And FIRC and BRC proves that there is a foreign inward remittance in case of service exports. So this fourth point is regarding compliance in context to exports of services. Now, fifth point is a general point. It says that in case last year there was a GSTR 9, then being an auditor, you need to ensure whether any timing difference transactions are getting knocked off in current year or not. Like there might be certain ITC which we have showed in last year stating that this ITC has been taken in current year. Then being an auditor, we need to check whether same figures are carried or not. Same way for 9C, many a times in last year 9C, there are certain points specified. Then being an auditor, we need to ensure whether those points are complied or not. Now, this point is simply about closing credits. Since last 2 years, as we have ensured to take credit as per GSTR 2B for our clients, in most of the assessee, the closing ITCs are always matching with the portals. But as an auditor, what I generally do, I generally take the screenshots from all the records, right from the GST portal to the books of accounts portal and to the audited financials, stating that all the three documents are having same input credits. Say we have audited a financial stating that IGST as X, CGST as Y. Then I will take a screenshot of books of accounts. I will take a screenshot of online GST portal of a particular date and will ensure that yes, all the three figures are in line up. And if there is any difference, I will ensure to keep a reconciliation of that. The eighth point is a general document which says that whether for that year reconciliation is done with GSTR 2A or 2B. So for example, for this year 23-24, I want to do a yearly reconciliation stating that we are in the month of March. It is on me which document I need to take on base. If we take GSTR 2A, it will be a summation for all the months. And if we take 2B, it is a static document. So for GSTR 2B, I need to take month on month. And if I take 2A, I can take yearly 2A, wherein 2A is a dynamic document. So I need to take a cutoff date for 2A. So that is on my discretion, whether I need for a reconciliation of that particular client's GSTR 2A or 2B as per the nature of business or as per the period I am taking. Say I am doing audit in the month of July, I would be taking GSTR 2A as a yearly document and compare with the purchase of the client. And I want to do a monthly reconciliation, I will take GSTR 2B. But whatever reconciliation whatever base document I will be taking as an auditor, I will keep that document in this file as a base document. Now, this point is about, see, generally in nowadays, in many of the clients, notices are coming based on 26 years. So for your clients, I would also suggest that you can compare the sales which is mentioned in 1.3B with 26 years. Because many a time certain incomes are directly getting popped up in 26 years, which assessee is also not aware. Like some of the interest income is anyway exempt, but there might be possible some of the commission income which are directly coming in 26 years and GST is not paid on that. Then this tracker will help you to have a compliance for those items which is directly coming in 26 years. See, there might be a certain scenario where client is having huge interest income, which is coming in 26 years. Though interest income is exempt, but officer can raise query on common credit reversal. So, for example, the interest income is say 2 crore and his business income is say 7-8 crore, and he is having a common expense for both the income, then GST department are nowadays raising queries for common credit reversal also. So in that scenario, they can take the information from 26AS, as 26AS is anyway external document. So being an auditor, we ourselves should first ensure that whatever is mentioned in 26AS is getting complied in GST or not. The third thing, this point is again very crucial, because generally we do RCM compliance on monthly data of the client, but many a time certain transactions are getting incorporated on yearly basis, on the year-end basis. Say for example, payment to advocate, the transaction JV or the journal entry for transaction is passed on yearly basis, and the RCM on that gets overlooked. Then what happens in the month of September or in the month of December, when we are doing yearly GST audit? At that time we realize that this compliance is not done. Then what happens in that scenario? Assessee misses the input credit, as well as they end up paying RCM with interest. So there are three laws in this case. He is paying interest on that RCM. He is doing late compliance, and the most important thing, he misses the timeline of taking the input credit, because last date of claiming the input credit is September. So generally what I do in my clients, I ensure to get those things, any missed transaction in the month of March itself, so that the transaction remains in same year. Assessee takes the input credit on time, and his interest amount also gets saved. So at year end, you can do yearly RCM report. The 11th point is also important. There are many incomes which get derived at the year end only. Say rent income, commission income, those all incomes are getting derived at the year end. You have a client, he is having only salary income, and at year end he receives certain rent income. Then this tracker can help you to ensure that yes, rent is taxable, I need to get the GST paid for this client. So if there is any other income at year end, you need to ensure that whether GST is complied or not. Now this 12th point is simply keep a documentation of any timing difference of transaction. As discussed earlier, that say we have certain ITC of last year taken in current year. So simply have transaction wise breakup of those ITC in this table. Same way, 13 point is also about timing difference. 14 point is also of timing difference. The purpose of taking this 3 point is to have the documentation line by line for those transactions. Now 15 point is again a very interesting point. This point I incorporated based on the experience of one of my GST audit. In one of my client, what officer did, he did the reverse calculation of the transaction based on the tax amount. So generally what happens, say a particular client is having a variety of rates of tax, say 5%, 18%, 12%. It is possible because there are various products or services which are having multiple rates. In that scenario, we being auditor, we need to ensure to have the to derive the taxable value based on reverse calculation, because many a time there can be mistake by accountant and or by the admin team while calculating the tax. So what happened on the invoice, it is mentioned say 5%, but actually system might have calculated 18%. Or there might be scenario on the invoice it is mentioned 18%, but system has calculated 5%. So in that scenario, what you being an auditor, you need to simply take the tax in a different head, divide that tax value, divide the tax value with the percentage tax, and come on to the figure of respective sales and purchase, and then compare that sales and purchase figure with actual sales and purchase figure which is mentioned in the books of account. Here, if there is a nominal difference, that can be ignored, but if there is a huge difference, then you need to get the transaction reconciled based on line by line item. And this error has actually happened in many of the assesses during the initial stage of GST. So taking that base from the coming years, we can have a practice wherein for each client, we can ensure to have reverse calculation, wherein if there is any error, it can be detected automatically. Now, 16 point is also a triggering point. This point also I have observed in few of the clients. See, as a GST 3B, set off is automatically. Set off means I am telling that how liability gets set off. It is against first IGST, then C and S. But this set off can be manually altered also. So if in your client, if the client has manually altered that, you being an auditor, you need to check it whether it is been altered, whether it is as per rules of GST or not. Especially in case of tour operator, what happens, for certain transaction you cannot use the input credit. So assessee need to compulsory pay the tax through bank. Input credit is not allowed. But if same tour operator for certain criteria of services, he can take the input credit. So there are chances that he has manually altered the GST set off. If the alteration is under the regime, means if the alteration is done as per law, then it is fine. But if it is alteration is done against law, then he can be in trouble during the assessment. And what is the problem? The GST portal doesn't restrict this manual alteration. This I have myself experienced. So this point, many of you might not be aware, but in case your client is having ITC usage restriction, you need to check this point whether set off is manually altered or not. This transaction is in case your client is having any branches, whether transaction between branches are as per GST law, and whether common credits apportionment is done or not, whether same is compliant or not, has to be mentioned here. This point is regarding in case your client is having any advances, whether advances are adjusted properly in GST of 1 or 3B. 20th point is again important. Validate the HSN GST rate for goods and services. Many a time what happens, HSN is going year on year same, but there are probability that clients add on certain new products and he is taking the earlier HSN. Even the requirement of HSN for certain turnover has changed. So being an auditor, we need to ensure whether he has changed the respective number of digits or not in HSN. 21 point is a triggering point, and especially in the western region, many of the notices are coming to assessee based on this point. This notice contains simply two things: turnover as per e-way bill, turnover as per GSTR1, difference, and officer will ask the reason of difference. So here, being an auditor, before the notices comes, let our client only prepare a reconciliation for if difference, if any. See, generally there can be many reason of differences. First, there are certain transactions which doesn't involve movement, like debit notes, credit notes, turnover discount, rate different discount. There is possibility that there is in any case of punching error. There are scenario wherein e-way bill is wrongly prepared. There are scenario wherein e-way bill is prepared but transaction was done halfly or halfway. In that scenario, what happens, once the notice comes, it becomes difficult for us to find the reason, as we need to dig all the past record. So what we can do, we can auditor right from the day one. We can have a practice at our client place wherein we can give them reconciliation template. We can give them a proper remark column stating that if there is any deviation between books of account and e-way bill, you simply mention the reason in this tracker. And what happens, if any notices come, our answer is ready. We can simply reply the notice within half an hour. So this is very important because nowadays department is having a artificial intelligence tracker, and in case of any difference, they simply shoot notice on this. This is again important in case your client is having any sort of GST refunds, whether those refund entries are incorporated in books of accounts or not. Because generally what happens, we file the refund online on GST portal, we find RFD 01. The refund get credited in books of accounts. But we need to communicate to the accountant that you need to reduce respective balance of CSI as same has been taken as refund. So this set of entry of refund, we being an auditor need to ensure whether it is correctly passed as per GST refund order or not. Now, 23rd point is regarding any canteen expense, notice pay expense, GST assessment expense, any DRC paid during the year. We being an auditor, we need to check whether respective compliance is done or not. Say if there is a canteen expense, whether forward charge is paid or not. For notice pay, now there is no more RCM, so no need to worry. In case there is any GST assessment during the year, we being an auditor need to ensure that for what points the officer has get the amount paid, whether those points are complied during the year or not. Now, 24th point is very, very important and very commonly raised in current GST audit, that is 180 days reversal. See, generally, we take input credit, we ensure whether input is coming in GST or 2A or not. And we ensure that invoice is there, goods are actually coming. This all condition are fulfilled. But this condition of 180 days is many times overlooked. So what happens if you're not paying your vendor within 180 days, under GST law, you need to reverse that credit and take the recredit again on the date of payment. So if within 180 days payment is not there, you are liable to pay interest on that credit and you need to reverse that credit. So at the time of year end, what you need to do, you need to see the creditor aging, and for any creditor where 180 days has passed, get the credit reversed, get the interest paid. Now, this 25th point is again crucial, which is many a time missed during the GST audit and during statutory audit, that whether export remittance has received within 9 months or not. See, this requirement get vary based on certain laws, but in a normal sense, within 9 months if export realization is not coming and you have availed export benefits, your export benefits can get challenged, and even as foreign remittance has not came, you are deviating the condition of exports under GST law. 26th point is again important. Income and expense grouping in audited financials. See, many a times what happen, certain expense are not actually a transport expense, but they are grouped under head of transport. Say payment to auto rickshaw, payment of conveyance to employees. They are not actually a GT expense, but grouped under the transport expense. Then what happens at the year end or during the GST assessment? Officer takes the figure simply from the audited financial and they will say that your audited financial is having transport expense as 5 lakh, but you have paid RCM on transport only on 3 lakhs. So pay the RCM on balance 2 lakh. So what I suggest that have the proper grouping in the balance sheet itself so that there is no ambiguity. So if the payment to GTA is 3 lakh, straightway report that transport under GTA expense under audited financial is 3 lakh. The balance 2 lakh is other transport expense, which doesn't fall in ambit of GST. If you are simply grouping totality 5 lakh, there are huge chances that during GST assessment, you need to justify this breakup of that 5 lakh, and you need to convince to officer that balance 2 lakh are not payment to GTL. So rather than from day one itself, have the proper grouping in audited financial itself. Point number 27 is also interesting. It says that if there is any written off of expense or any written off of creditor data, then there is a GST implication on that. So if you have written off any creditor, you are having a deemed income, on that you need to pay GST. So at the year end, if your client is writing off any creditor, get the GST paid on that, considering it as a deemed income. Now, point number 28 says that in case of any foreign payments, whether your client has made RCM compliance or not. So if any forex is going outside India, and if it is the service falls under the list of RCM, the place of supply is falling outside India, we need to validate that. And if that particular transaction fall under the RCM, fall under category of RCM, we need to get the reverse charge complied on that. For example, you have bought online themes, you have bought online services, web development service, you have bought any online templates All the services falls under ambit of OIDR, and any OIDR services, online information database access trial services taken by your client is subject to reverse charge. See, again, the purpose of mentioning this point in this tracker is that you don't miss the compliance on that point. So whenever you are doing audit of your client, and if that point is mentioned in this tracker, you can simply mention that yes, there is OIDR services, RCM is yet to be complied, and during this month, this compliance will be done. Now, point number 29 says about ocean freight RCM. Earlier, many of the assessees has paid RCM on ocean freight, but now the Supreme Court judgment says that we don't need to comply RCM on ocean freight. So if in your client you have already paid the RCM, you can guide your client to take the refund of same. Point number 30 is same. Say for your client has paid any Amazon server rent, your client has taken the services of Zoho, taken the services of Zoom, have bought online ebooks, have bought any online themes. All these services falls under OIDR, and you need to get the RCM paid. And especially for Amazon and Google bills, there can be two sort of invoices. Many a time Amazon and Google bills come from the Indian entity. For those invoices, they are already charging GST. So you don't need to comply reverse charge. But there are chances where Amazon and Google bills are coming from outside India. For those invoices, yes, we need to comply the RCM. Now, ITC on pre-bid expenses. So if in case month end, year end, there are a possibility that certain expenses pertain to next year. Then in that scenario, we being an auditor should ensure that whether there is a pro rata reversal of ITC and ITC is taken to the next year or not. Point number 32 is about common credit, about food credits in pertaining to food, insurance, car, construction, any sort of medical, rent-a-cab. This all credit falls under the ambit of 17 subsection 5, that is block credit list. So if your client is having any sort of input trade which falls in the category of block credit, we being an auditor need to ensure whether same has been reversed or not. This point is also very important because this point is simply raised under GST audit. So you need to ensure whether your client has not taken any credit pertaining to car, food and beverages, construction, any damaged goods, club, medical, rent-a-cab. Rent-a-cab is allowed only when it is as per law requirement. So say certain call center services, there is a mandatory law requirement wherein company need to drop their employees. In that case, rent-a-cab is allowed, but in other scenario, rent-a-cab is not allowed. Same way for insurance, input credit is not allowed. For health insurance, medical insurance, keyman insurance, input credit is not allowed. It is allowed only when it is requirement of the Factory Act. Same way, you need to ensure the RCM compliance for rent-a-cab, advocate, transportation, security, any payments to director in capacity of director. See, generally what happens, if you have seen GSTR 2B, it also has certain transaction wherein there is a flag of RCM. So being an auditor, we can take the data from 2B, we can detect the transaction having flag of RCM, and then compare those flag transaction with the transaction of books of accounts, and then whether for those transactions which are mentioned in 2B with the flag of RCM, whether RCM is complied or not. Now, point number 34. It says that if your client is having any sort of pending appeal, litigation, show cause, anything going on, whether same points are there in current year also or not. If the same point, like the point which is under dispute in earlier year, whether same point is there or not. And if that point is there, what stand the company has taken for that current year. Now, this point is again important. It says that if in your case, a company is having any sort of exempt income or any sort of sale of land, closing stock damage, or sale of mutual fund, whether ITC is reversed or not. So if your client is having any sort of sale of mutual fund transaction, then there is a rule under GST which says that you need to, under deemed fiction, you need to take 1% value of that mutual fund transaction as the exempt value transaction and get the common credit reversed. This point is many a time missed out, because generally what we take income side of balance sheet, sorry, of P&L, and a sale of mutual funds comes under balance sheet. Like, it is simply the reduction of the value of mutual fund. So this point is many a time missed. So in case your client is having a sale of mutual fund, ensure to have a common credit reversal. Same way in case of sale of land also, though land is a no supply transaction, but common credit reversal comes for this. Same way in case any closing stock is getting damaged, ITCs need to be reversed for that. This point is simply regarding exports. Say in case your client is an exporter, as discussed earlier, ensure on a manual basis, you can randomly pick certain export invoices, and you can ensure whether on those invoices LUT number is mentioned or not, and a proper export declaration is mentioned or not. Because if that declaration of or LUT number is not mentioned, that in that scenario, that export will not be called as a valid export. Same way, in case your client is having any sale of used car, machinery, any fixed asset sale, whether GST is paid or not. Now, in case your client is having any sort of GST payment, any sort of export with payment of GST. See, for export against LUT, refund is filed on manual basis. But for exports against with payment, refund comes under scroll-based refund, that is auto refund. So for those clients, you need to ensure whether all the shipping bill details are matching with GSTR1 or not. Because see, if the shipping bill detail for those transaction is not matching with GSTR1, the scroll-based refund, auto-scroll-based refund will not come. So we being an auditor, in the month of March, we can ensure that for entire year transaction, whether refund has came or not, and if refund has not came, get those transaction amended in GSTR1, and if the error is in shipping bill, get it corrected. Because this refund comes only when there is a knockoff of the details of shipping bill with GSTR1. So in your client, if there is a scroll-based refund, ensure whether those refund has came or not, and if it is not came, get it corrected in respective GSTR1. This is again interesting. For many a time, what happened, we presume that if the particular transaction is coming in GSTR 2A, we assume that yes, this transaction is a genuine transaction. But there are scenarios that client is not having the respective purchase invoice, or the purchase invoice is yet a pro forma invoice and not the final invoice. Then in that scenario, during GST assessment, officer disallowed the credit as the respective document is not a valid document. Then for a client having major purchases, we being an auditor can have a random invoice checking, wherein ensuring whether purchase invoice is having all the particular as per the requirement of GST law or not. Point number 40 states that just have a rough calculation of entire year. For any month, if assessee has delayed the return filing or delayed the GST interest payment, get the yearly interest calculated, and any differential interest, get it paid in the month of March itself. So friends, this tracker is a very simple tracker containing the 40 points. But if you see a overview angle, I have tried to cover the points from all the aspects, and in totality 90 to 95% points of compliance are covered. So now whenever you are doing planning for your client for GST audit or statutory audit, I would say this document play a vital role in statutory audit itself, because in statutory audit our own is to have validated all the aspect of all the law. So if you are giving this document to your team, he will try to cover all the aspect during his stat audit or during his GST audit for that. client, and most of the compliance would be covered from angle of GST. So as my topic suggests, it says that yearly GST tracker, easy steps towards GST compliance. So I have simply mentioned a 40-point step wherein I have tried to cover various aspects of GST. Many of the aspects are very known aspects, but purpose is to simply cover all the points under one roof. So now let's again move on to the presentation. I hope presentation is more visible. So we have walked through GST health check tracker, a 40 points tracker. Now there is a small thing that the point I mentioned is connecting the dots. So generally, what I believe that the ultimate objective of bringing GST is to subsum all the indirect taxes. But now GST is again a playing role with other taxes also. So here there are 7 blocks wherein I am just giving you a thought point, which I feel that while doing this year's statutory audit, it will play a important role in your analysis and thinking process. So first thing is very simple. We all know that we need to map the GST with the income tax return, because nowadays notices are coming from income tax department also that turnover as per GST is this and your books of account is this, justify the difference. So this point we can justify at before issuing the notice. If there is any difference, let's have the justification for same at the day one. The second point we already discussed, that is 26 years versus GST. We being an auditor, we need to ensure that if any excess income discovered in 26 years, whether GST is complied on same or not. The third point is again interesting, which we might not be aware, but I would say that if that is there in your client, get it complied right from day one. So if there are any transactions which are reported in FEMA, ensure that whether GST is paid on those transactions or not, if there is applicable GST or not. So for example, you are filing 15 CACB for a particular assessee and getting it complied, then being an auditor, your additional role is whether on those transactions RCM is coming or not. Because under 15 CACB, you are straightway stating that yes, Forex is going outside India, the nature of service is this. Then additional thing to justify here is that whether RCM comes or not. So if the place of supply is outside India, RCM will not come. If place of supply is in India, RCM will come. So for example, you are getting payment done for any technical services taken in India to a foreigner. Then while filing the 15 CACB itself, you need to tell to client that friend, RCM will also come for this transaction. And say, take an example, there is a payment for any outside India exhibition. The place of supply of same is also outside India. Then in that scenario, you can simply mention that the transaction is outside the ambit of GST. Same way FLA and GST. So if for any client you are filing foreign asset liability return to RBI, then any turnover mentioned in an FLA should get mapped with GST returns. Same ways with SEZ. So if your client is SEZ and you are filing annual performance report, so any turnover, any purchase detail, any service detail mentioned in APR should match with the GST return. Now, fifth point is if in your client say he is having salary payment and he is having PF and PT. Say in salary is mentioning 200 rupees and in PF and PT he is mentioning 180 rupees. There is a difference of 20 rupees. Then there are chances that he has mistakenly taken the head of salary, and that 20 rupees is say payment in capacity of director or in any other form. So there are chances that head of salary is taken mistakenly just to ensure that GST is not to be paid on that. But what happens whenever there is a GST audit from the department, they validate the salary return from PF and PT also. So here being an auditor, we need to have it validated right before the officer says. Last point is also an interesting point, getting the records compared with ROC. Though ROC is again filed based on the audited financials, but getting GST grossly checked with ROC is also one of the checkpoint. So this is connecting the dots with other laws in context to GST. Now, the last thing is very simple, but again, eye-opener. Say my books of accounts are finalized, my books of accounts are audited. From those audited books of accounts also, there can be certain things which we being an auditor need to ensure whether it is properly mentioned or not. So balance sheet and P&L, we already saw while going through that checklist that what we need to take care in context to other income regarding sale of mutual funds, sale of land, sale of fixed asset. All this transaction, what taken care we need to see in context to GST that we understood through that walkthrough. But last point, what accounting policies and director report can play a vital role in context to GST. See, recently in one of my client GST audit, what happened that officer called my client and he asked him that under director report, you have mentioned 2 crore rupees payment to director and you have mentioned 5 crore amount as foreign exchange outflow. See, we all know that director report, we need to have 3 schedule. One is foreign inflow outflow schedule and another is payment to director. So whatever is reported under director report becomes a base thing for the officer. So we being an auditor need to first validate that with any information mentioned in director report, whether that is mapped with books of accounts and whether respective GST compliance on same is done or not. So in case of payment to director, if any payment is in capacity of director other than salary, whether RCM is complied or not. Secondly, if there is any foreign outflow payment, whether RCM is complied or not, if there is any foreign inflow payment, whether supporting FIRC, BRC is there or not, whether exports are supported with LUT or not, whether exports are having getting remitted within 9 months or not. These all things are are coming with accounting policies and director report. Now, accounting policies. For accounting policies, the last thing which I would like to convey, many a time we report segments in accounting policy, and some are segments based on the state, say Gujarat, uh, Tamil Nadu, Maharashtra. So, if you are having segment reporting in your accounting policy, you need to ensure whether intercompany transactions are knocked off, and if those intercompany transactions are knocked off, whether transactions are getting complied in case of cross charge under branch under GST. So this information also getting derived from accounting policy. See what happens, officer will simply state that in your audited report you are mentioning 3 states and your offices are there in 3 states. Then as an auditor, we need to get the intercompany transactions also complied from angle of GST. So friends, this was all about GST tracker, and any questions you can ask.
Thank you, Sonal,
Yes.
for your the wonderful and knowledgeable session on the GST compliance. And I guess it will definitely help all our all our practitioners to ensure a smooth GST compliance for the client for the year ending 2023-24. And there is not only for this year and for the future litigations also, this will help a lot. It will we can just compile all the data as you have told in your 40 this point tracker. You have summarized all the basic data from all the specific client-based data also. All details are there. So we can have all the data in just one Excel sheet, and that will be very helpful in the future coming years. Like sometimes we have we receive show cause notice after a span of 3 years or after a span of 5 years, when we don't have the data also that time. And that time this GST tracker will help a lot.
Right.
And let's go to some question and answer we have from our viewers.
Yes, yes.
Sonal, our audience is asking for, can they have this GST tracker Excel sheet? Can we share with them?
Yes, I will email to you and you can share to participants.
Okay, thank you. And yeah, this is the only thing the audience is asking now. They just need this GST tracker.
Sure, sure.
Okay. Thank you, Sonal. Thank you once again.
Thank you. Thank you everyone for patience listening, and I hope I justified the topic. Thank you.
Yeah, definitely. Thank you. Now I welcome, on the behalf of Women and Young Members Excellence Committee, our next speaker, CA Abhinaya MA. CA Abhinaya MA, she will deliver her session and throw some insights on the Indian Budget 2024. How to prepare ourselves for this coming budget 2024. Just a brief intro of CA MA Abhinaya. CA Abhinaya is currently practicing as a senior associate at PwC, and she's specializing in corporate and international taxes. Throughout her academic career, she has received many awards and accolades. She has scored All India rank 17 in CA final exams and All India rank 26 for CA intermediate exams also. And during her schooling also, she has been toppered in the state of Tamil Nadu, and she has been awarded by the late Chief Minister of Tamil Nadu also. Her core area of practice is corporate and international taxes as well as the domestic taxes also. She has taken many knowledge sessions in the ICI, various ICI programs. And apart from this professional career, she performs Carnatic music vocal concerts, and she has been also awarded All India Radio B Great Artist. I heartily welcome C. Abhinaya MA on behalf of Women and Young Members Excellence Committee to please deliver your session on the India Budget 2024, how to prepare ourselves for this forthcoming budget. Thank you, Abhinaya. You are welcome now, and all your dais is yours.
Thanks, Shanu, for such a warm welcome. I'll present my screen. Hope my presentation is visible.
Yeah, it's visible.
Yes. Very good evening and Happy New Year to all my fellow chartered accountants who have gathered online for this session. And yes, so we are nearing the day, the most sought after day, which determines the economic fate of our country, which is 1st Feb of this year. It's not only this year, but every year, the 1st February, on which date the budget will be announced by the finance minister. And that is the topic which I have taken for today. So the topic is the India Budget 2024, Prep Yourself. So you might think that a lot of lectures, technical lectures, questioning the technicalities, legalities of all the amendments that has been introduced as a part of the budget, will take place after the budget has been pronounced. But what are we going to do before the budget? Maybe your guesses might be something around the budget expectations, especially the 2024, the election year budget expectations. But today's session is not about that, but it is about the preparation that we need to make for ourselves before facing this year's budget or before facing any year's budget. So, as far as today's session is concerned, let us focus on the topics that we need to be aware before meeting the budget as such, which will include how to read the budget documents or what are all the budget documents that are available per se, its value, its importance in our day-to-day practice, and there will be a lot of intricate interpretational issues on the content of the budget documents. So how are we going to go about that? So let's discuss some of those interesting and fascinating topics today. And you might think that why should we prepare ourselves for the budget because we are not the finance minister and it's only the finance minister who needs to prepare for the budget? It's not like that. So just like how you prepare for a meeting, you need to be prepared for the budget so that you are well aware of what will be upcoming, especially the documents that are contained in the budget as such, and how do we interpret, how do we go about it, and what impact does it have on our day-to-day practice. So that is what we are going to have in today's session. So let's have a little bit of intro about the budget and a little bit of history as well. Then let's have some sort of a discussion about the legal background about the budget. Then we'll go into the content of the budget and most importantly, the prep points for us. So whenever you think about budget, these are all the things that comes to your mind. So it could be tax slabs, say for example, whether it is going to be 2.5 lakhs of basic exemption limit or whether it is going to be raised by the finance minister during this budget, all of those things will come to our mind. And apart from that, are we going to get more deductions under 80C? Are we going to get more deductions under 80D as a part of medical insurance premium? And all these things will be rolling over our mind. Then the traditional Carrot Alwa ceremony, which happens a week before the budget day. And then there could be a wavering observations about the GST rate, whether the products are going to become costlier or whether they are going to become cheaper and all these things. So if the current GST rate is say 12% for a product, then is it going to be raised to 18 or 28 or is it going to be reduced to nil? And it depends upon the importance of such product to our economy and what is going to happen to the fate of that product. So all these things might be revolving around. Then the suitcase, which will be taken by the finance minister while presenting the budget, and recently it has been replaced by a electronic device, a tablet. And more importantly, the industry fascinator. Say for example, someone will be more interested in knowing about the industry in which they are working on. Say a person who is working as a part of a software company, he might be well interested in knowing about the budget allocations for the software industry. A person who is working in a medical or a health sector, he might be very interested in knowing about the allocations, the programs that the government is going to bring about as a part of the budget. So it could be a sector wise or an industry wise analysis that could be done as a part of the budget. So these are all the normal things that you think about when that you get to your mind when you think about the budget. There are some other interesting facts about the budget. So let's discuss some out of it and then move on to the crux of today's session. So, as we all know, the term budget would refer to the forecast of income and expenditure, just as how we forecast our household income and expenditure, just as how the income and expenditure of a company is being forecasted and industry is being forecasted. Similarly, the government also forecasts the income and expenditure of the nation as such, and that is being presented as a part of the annual budget, and it is set out by the Ministry of Finance, and more specifically the Department of Economic Affairs will be the sole body who will be working on the budget as such. And historically it has been presented on 1st Feb, but it is interesting to note that until 2016 it has been presented on the last working day of the month of February, but with effect from 2017, that is budget 2017 was presented on first day of Feb. Maybe the reasons could be because after the last day of Feb, it's just 1 month for the government to wrap up the process of getting an approval from the Rajya Sabha, from an assent from the president, and implement those things from the next financial year, which starts with 1st April. Maybe for that particular reason, they could have pushed it prior to the last working day of February, more importantly on 1st Feb. And until 1999, if you see, the time when the budget was presented was at 5 p.m. You could think. So normal working hours for any company could be from 9 a.m. or 10 a.m. to 5 p.m. So why is the government presenting a budget at 5 p.m.? So there's a lot of hearsay that at 5 p.m. it will be 11:30 a.m. in England, and therefore they wanted to present it. And this was the practice from the ages of Britishers, and therefore they wanted to continue it at 5 p.m. but this was at last changed from the year 2000, again under the NDA's NDA government's period, and this continued, and very recently it has been changed to the 1st of Feb, and the timing is also changed to 11 a.m. Then there is one other aspect that we need to know, and especially this being an election year budget, we need to know about these two terms. It's about vote on account, and the other term is interim budget. So most of the times people misplace vote on account with interim budget. But the question is whether vote on account and interim budget are the same. It's not the same. There is a slightest of difference between these two. If you see the Indian Constitution, Article number 116 of the Indian Constitution defines a vote on account as an advance grant that is given to the government from the Consolidated Fund of India, and that is to cover the short term expenditure requirements. Whereas on the other hand, the interim budget is a complete set of accounts. So to put it simply, vote on account will just contain a budget on the expenditure side, whereas interim budget will be a full-fledged budget with a budget on the income as well as on the expenditure. So why is this important for an election year? In an election year, so whenever you take a budget, that will have its force only until 31st March of the financial year. So say for example, budget 2023 will be in force only until 31st March 2024. So budget is not only important for finance bill or the other aspects, but it is also important because only when the funds are allocated as a part of budget, those funds will be made available to the government for spending. So therefore, even from that perspective, if you think this vote on account will just be a budget on the expenditure side, more to say that this is the expenditure that the government is expecting to happen between 1st April until the date of election, and therefore this is being presented before the parliament. And they don't want to present a full-fledged budget for the whole year because there could be some changes in the elections. So for that reason, this is vote on account, whereas interim budget is a full-fledged budget. It will have tax policy decisions, the other decisions, fiscal deficit related decisions, financial performance projections for the upcoming financial year. All those things will be there as a part of interim budgets. Till now, as a part of as a statistical thing, there were 14 interim budgets presented. The last interim budget was presented ahead of 2019 general elections by the then acting finance minister Piyush Goyal. So according to the Election Commission's Code of Conduct, an interim budget cannot include any major scheme as it may influence the voters, and therefore that can be set as an expectation for the budget 2024 because this being an election year. So with this, let's move on to the next section of today's session. So it's our practice as a CA to go to the source of source for anything and everything that we read. So similarly, here, let's understand the source of budget. So it is being presented at the time of presenting annual financial statement. So what is this annual financial statement about? So there is an article number 112 of the Indian Constitution. It requires the government to present to the parliament a statement of estimated receipts and expenditure in respect of every financial year, which will be between April 1 to March 31. And this is what is called as annual financial statement. Basically, if it's a budget 2024, then it will mean that the government will give its estimated receipts and expenditure for the financial year 2024-25, and that is what is referred as annual financial statement. Now, budget is a part of the annual financial statement. Now you might think, then what is it about the finance bill? Yes, so finance bill is a money bill which is being passed as a part of the annual financial statements, as a part or at the time of presenting the annual financial statements. Now what is this money bill? Again, let's refer to Article 110A of the Indian Constitution. Here the money bill is being defined. It says, for the purpose of this chapter, a bill shall be deemed to be a money bill if it contains only provisions dealing with all or any of the following factors. Amongst others, it includes this line, which is about the imposition, abolition, remission, alteration, or regulation of any tax. Apart from this, the scope of money bills is to regulate borrowings, is to regulate the custody of consolidated fund, contingency fund, or payment of monies or withdrawals of monies from those funds, appropriation of monies, or declaring any expenditure to be an expenditure charged on these funds. All those things are also included as a part of money bills, but for the purpose of our discussion, let's keep it restricted for the tax related matters. So here, money bill includes within its scope some bill which imposes, abolishes, remits, alters, or regulates any tax. It could be any tax, it could be income tax, it could be GST, it could be stamp duty, it could be any taxes of whatsoever, but it should be taxes. So that is more important. So, and that culminates into the next point, which is the scope of money bill. The scope of money bill is very important because, say, for example, there is an amendment which is being made in respect of insolvency bankruptcy code, which is unrelated to taxes. Then there comes a question as to whether that can be made as a part of the finance bill. Similarly, say for example, there is a Prevention of Money Laundering Act, and if there is an amendment which is brought into that particular legislation as a part of finance bill, then the question could arise as to whether that can be done as a part of finance bill, because finance bill is a money bill and it can be only related to taxes. And there has been several rulings, or there are cases pending before Supreme Court on whether the amendment made in respect of a PMLA can be done through a finance bill and whether it is a valid amendment. So therefore, the scope of money bill is something which is very important. Now, let's also take a very glimpse of the procedure relating to the passing of money bill. So as we all know, money bill will get introduced only in Lok Sabha. Then you might ask the question, why not in Rajya Sabha? Because it is specifically prohibited in the Indian Constitution, Article number 109. It says that a money bill cannot be introduced in the Council of States, which refers to Rajya Sabha. So it can only be introduced in Lok Sabha. Then it goes to Rajya Sabha seeking their recommendations, and the time limit that is given to them is only 14 days. Within 14 days, they need to revert. If they don't revert, then the finance bill will be deemed to have been passed by Rajya Sabha. If they revert with recommendations, and it is up to the Lok Sabha to either consider and accept it or to reject such recommendations, it is up to them. Then after that action happens, the Lok Sabha will present the finance bill to the president for his assent. Again, president may give his assent or may return the bill for reconsideration by the Lok Sabha. If returned for reconsideration, again, it's up to Lok Sabha to accept those recommendations and make changes as may be necessary and send it to president. Or they might think that no, these changes are not necessary and we are going to retain the same. And again, they might send it to the president, and president has to give his assent. This time he cannot send it back for reconsideration. So this is about the procedure of passing a money bill. So once the president's assent is given, finance bill becomes finance act, and that is the procedure that is being followed every year, and that is as per the provisions of the Indian Constitution. Now we'll go to the main part of today's session, budget's content. So you might think that budget is all about finance bill. Is that so? That is not only about finance bill. There is a lot more in the budget which is happening. So these are all the budget documents which will be presented every year. Annual financial statements. Annual financial statements, as we already noted, that is nothing but the estimate of the income and expenditure for the upcoming financial year. Demands for grants, again, it's an estimate of expenditure from the Consolidated Fund of India, which is included as a part of annual financial statement. But this needs to be submitted by the Lok Sabha in the form of a demand for a grant. So they are requesting for money, something like that. So it needs to be submitted for each ministry or department. Then the third most important thing, finance bill, which will be the subject matter of our discussion today. And the next one, fiscal policy statements mandated under FRBM. FRBM is Fiscal Responsibility and Budget Management Act 2003. Then expenditure budget, then receipt budget, expenditure profile, budget at a glance and key features of budget, implementation of prior year budget, then memorandum explaining the provisions in the finance bill, budget speech. So all these documents bucketed together will form part of the budget documents which is getting released every year. You can access for all the prior years using the Indian government's website. Now, the more important things are highlighted in red. before you. So it's finance bill, memorandum explaining the provisions in the finance bill, budget speech. So all these three documents revolves around the amendments in taxation laws. May it be income tax, may it be GST, may it be the other taxation laws. So these three documents are very important. Now, let's go into the contents of finance bill. It consists of 5 chapters. Chapter 1, preliminary. Chapter 2, rates of income tax. Chapter 3 deals with direct taxes. Chapter 4 deals with indirect taxes. Chapter 5 deals with miscellaneous. It could be some other taxes. Say, for example, it could be stamp duty or the other duties and taxes which are being levied. And there will be schedules which will be annexed to the finance bill. More importantly, the first schedule, which is linked to chapter 2, rates of income tax. Yes, so chapter 2, rates of income tax, and the first schedule needs to be read through together. Now, if we start with chapter 1, let's go one by one. Chapter 1, preliminary. So, what is there as a part of this chapter? It consists of title. So, just like how we introduce ourselves, Finance Bill also will introduce itself as Finance Act. This will be called as Finance Act so and so year. So, if it is for say 2024, then in Budget 2024, Finance Bill 2024 will be passed, which will mention itself as Finance Act 2024. And it will specifically mention about the commencement of the Finance Act. What is it about commencement? We'll deal with it in detail later in the later part of today's session. But as far as direct tax is related, it applies with effect from the consecutive April 1. To put it simply, say for example, if it is going to be Finance Bill 2024, then all the direct tax related provisions, unless otherwise specified in each of those sections which are getting amended, it applies from April 1, 2024, that is assessment year 2024-25. So you might think that, okay, only in February 2024, I'll be able to know the taxation laws relating to financial year 2023-24. Yes, that's right. But we'll come to the anomalies or the issues that arise because of that in the later part of today's session. And indirect tax related, it applies with effect from the date of notification of that particular provision. So this is about the preliminary chapter. Very simple, but very impacting. Chapter 2, rates of taxes. Now, the rates of taxes will have its reference to first schedule. Now, what is this first schedule? This first schedule is very important. It has 4 parts. Part number 1, which refers to tax rates for various types of SSEs, may it be individuals or AOP, BOI, partnership firm, LLP, companies, whatever it is. For various types of SSEs, it will mention the tax rates. 24. Then the tax rates for assessment year 2024-25, which is previous year 2023-24, will be mentioned. If it is a Finance Bill 2022, then the tax rates for assessment year 2022-23 will be mentioned over there in part 1. So it is not about the future previous year, it is about the future assessment year. It is about the upcoming assessment year. So Finance Bill 2024 will refer to the tax rates for assessment year 24-25. Part 2 is about TDS rates for the upcoming financial year. So this is for the financial year, not for the upcoming assessment year. So part 2, Finance Bill 2024, then in that case, TDS rates for financial year 2024-25 will be mentioned over here. So it is for the upcoming financial year. Part 3 will mention about TDS rates for salaries, advance tax rates for the upcoming financial year. So if we just see it as an overview, part 1 is for the upcoming assessment year or the ongoing financial year. Part 2 and part 3 is for the upcoming financial year. So that is the difference. And one more important point is part 3. If we take the advance tax rates that is applicable for the upcoming financial year, that will take its place as part 1 of the next year's budget. Say for example, Finance Bill 2024 mentions the advance tax rates for financial year 2024-25. and that will become part 1, which is the ongoing financial year rates, tax rates, part 1 of Finance Bill 2025. So that is how we need to interpret this first schedule. And part 4 is about the rules for computing net agricultural income. That has not got much of its changes till date. So this is about first schedule. So to summarize, part 1 is for the ongoing financial year, part 2 and part 3 is for the future financial year. So that is the summary. So this is more important because this is where the tax rates are getting imposed and are getting mentioned over there. So and the definitions for chapter 2 and first schedule will be mentioned together. If it is not defined over there, then we need to refer to the Income Tax Act. This is about chapter 2. Now let's go on to chapter 3, chapter 4 and chapter 5. We are reading it together because it can be combined together as such. So here the changes that are being brought in as a part of finance bill could be of 4 kinds. It could be an insertion, it could be an amendment of an existing section, it could be an omission of existing section wherever the section is not required, and it could be a substitution of an existing section. So the first thing, which is insertion of new section, say for example, we had Finance Bill 2021, which introduced section 194Q. We had Finance Bill 2023, which introduced section 194BA, winnings from lot online games. So these are all insertions because these sections were not prevailing before that finance bill, and this will be introduced as a part of the finance bill. Now the next thing is amendment. So existing laws will be will be amended. Say for example, we had a amendment in section 43B in Finance Bill 2023, including within its ambit payments to MSMED creditors. So similarly, we had an amendment in section 32, removing the reference to goodwill for the purpose of IT depreciation. So these are all amendments to the existing section. Then the third one is omission. So wherever it is not required, say for example, Finance Bill 2023 removed section 88 because it is no longer required in the statute, and therefore they removed it. So this is about omission. And the fourth one is substitution. Section 245, say for example, which dealt with set off and withholding of refunds in certain cases, and that was substituted with a new section as a part of Finance Bill 2023. So earlier the provisions were different, and that was altogether substituted with a new provision, and that is what is covered under substitution. So the introduction or whatever changes that the finance bill is going to introduce, that could take part in any of these forms in the finance bill. So note down for these terminologies, because these terminologies will be there even as a part of the index of the finance bill. So whenever you read Finance Bill 2024, note down how many sections are being inserted, how many sections are being amended, omitted, as well as substituted, and that will be there as a part of index. That will also be there as a part of the margins of each of the pages of those relevant chapters. Now let's move on to the budget prep points. So here we are. There is a lot of interpretational issues that could arise as a part of reading through the budget. The object of any budget, so just like how we have the object of any statute, similarly the budget will also have its object, and it will say that it is to give effect to the financial proposals of the central government for the upcoming financial year. So similarly here also, budget, say for example, if we take Finance Bill 2024, which is going to be passed, it will have its object as to give effect. Am I audible? Shanu, Sunita, can anyone confirm? Am I audible? Sure. Thank you.
Yes, you are audible.
Sure. Thank you.
Now not, I think, not audible.
Okay. Okay, I'll just proceed. In case there is any
Not
difficulty.
audible.
Is it better now? So
And we'll tell Jay, tech host, tech Jay.
okay, I'll just continue. Maybe in case of any difficulties, just let me know. So the object of finance bill will be to give effect to the financial proposals of the central government for the upcoming financial year. If it is going to be finance bill 2024, then the object will be to give effect to the financial proposals of the central government for the financial year 2024-25. Now, you might think, okay, this is the object, but how should I read through the budget? And when is the finance bill effective? And there will be a lot of dates that you can come across in the finance bill. Which of those dates are relevant? And from which date is the provision going to be effective? That is the most important thing that you need to understand before even you start going through the budget or the finance bill document as such. The first screenshot that you are viewing now is a screenshot from the Finance Bill 2023. If you see the highlighted words, it says, save as otherwise provided in this Act, Section 2 to Section 122 shall come into force on the first day of April 2023. So, what is it about the term come into force? So, does it mean that all the sections mentioned in the finance bill will come into force on 1st April 2023? Or does it mean that the Finance Act as such comes into force, but not the provisions which are mentioned in the Finance Act? So, it's the later interpretation that holds good. So, typically, the term come into force can be seen in section 1 of whatever legislations that are being passed. Say, for example, if you take Income Tax Act, so there section 1 will say that this will come into force on the first day of April 1962. If you take CGST Act, then it will say that this will come into force on the first day of April 2000 on of June 2017. So every act, whichever you take, it could be even Information Technology Act. So section 1 will mention the date on which it comes into force. But this is about the effective date of the legislation, and this is not about the effective date of the provisions contained in the legislation. That is quite different. At least this kind of an interpretation holds good for the finance bill. Let's take an example. Let's take the Information Technology Act 2000. It came into force on 17th October 2000, but it got its president assent on 15th August 2000 itself. Say in between 15th August and 17th October, say exactly a day before 17th October, on 16th October, a person violated the provisions of Information Technology Act 2000. Now, will he be liable under the Information Technology Act 2000? There comes the importance of the term come into force. So the act itself comes into force only on 17th October. Therefore, a person cannot be penalized for his action which was done prior to the date on which it comes into force, which is on 16th October. So that is where the term takes its importance. So the effective date of the law's application will play a very crucial role in determining its impact on the taxpayers, allowing them to prepare, plan their next steps accordingly. So this is about the first date that you will come across in the finance bill. So this is about the effective date for the finance bill, not for the provisions contained in the finance bill, because that will have specific effective dates for itself, which we are going to see now. The second screenshot that you're viewing is about the effective date for a particular amendment which is brought in, and this will be seen as a part of chapter 3, direct taxes. Similar provisions will be there as a part of chapter 4, chapter 5, miscellaneous, chapter 4, indirect taxes as well. Similar kind of amendments or changes will also be brought in. So this second screenshot, if you see the highlighted words, it says with effect from. So what is this date and how is it different from the first terminology which we read? The second terminology is effective date. It says with effect from. So this is used for mentioning the effective date of that particular provision. And this is different from the date on which it comes into force, because the first one, date on which it comes into force, that is applicable for the Finance Act as a whole, whereas the effective date is for a particular provision. Now, a question might arise. Can an effective date be retrospective? Yes, it can be retrospective. It can be prospective as well. Let's take an example. It's a prospect. The first screenshot refers to a prospective amendment, and this is being taken from the Finance Bill 2023, which amended Section 206C of the Income Tax Act, TCS provision. So here it says with effect from the first day of July 2023. Why are we saying it's prospective? Because it comes into effect only after the budget date or after the date on which it comes into force. The Finance Act comes into force on or after the date on which it comes into force, and therefore it is being a prospective amendment. Now, if you see the second screenshot, this is a screenshot from the Finance Bill 2022, where they amended Section 40A2 to include the term surcharge and cess as a part of the definition of tax. Now, if you see here, this is a retrospective amendment because this says it is with effect from the first day of April 2005, which means that it is effective from a past date. It is effective from a date which is before or earlier than the date on which the Finance Act comes into place. So, therefore, this is a retrospective amendment. If you see through very minutely, then we can even divide this further to say about retroactive statute and retrospective statute. A retroactive amendment will operate as of a time prior to its amendment, which means that it operates backwards. It changes the law from what it was. Whereas retrospective amendment, it will operate only for the future transaction, but it does not impose it to say that it is just prospective, but it imposes new results in respect of a past event. That is what is called as retrospective amendment. So just to summarize, we have prospective, which operates only for future transactions with effect from a particular date. We have retrospective, which operates for the past years as well. Retrospective can again be divided into retroactive and retrospective. Retrospective, in the sense, it imposes new results in respect of a past event, but retroactive will be applicable backwards, and it changes the law from what it was earlier. So that is the difference between these two. Now let's question ourselves. Now, say for example, if we are going to see in the Finance Bill 2024 some retrospective amendment, the Finance Bill calls out that this is applicable with effect from 1st April 2016. Then it's a retrospective amendment, right? Can a retrospective amendment be valid? And what is the status of a retrospective amendment as far as the Indian laws are concerned? So here we need to refer to the Parthasarathi Shom Committee's recommendations. So they have given a very useful insight regarding the retrospective application of tax law. So they mentioned that yes, retrospective application of tax law is doable, it is valid, but provided it comes with any of these three objectives. The first objective is to correct any apparent mistakes or anomalies in the statute. Say, for example, there is a word which is missed out in a particular section. That can be retrospectively amended. And the section was introduced, say, with effect from 1/4/2020. And the government came to know about the apparent mistake or anomaly in the wordings used in the provision only in 2022. Now they can go back and amend it with effect from 2020, because this is to correct the apparent mistakes or anomalies in the statute. Here the retrospective amendment is valid. Second, to apply to the matters that are genuinely clarificatory in nature, to remove technical defects. Say for example, if it is just to clarify something, and this was something which was there with effect from the date on which the provision was amended or introduced, but merely to clarify the intent of that provisions, this particular amendment can be introduced. So a retrospective amendment can be clarificatory, or it is to clarify a particular provision. This is the second objective. The third objective is to protect the tax base from highly abusive tax planning schemes that has the main purpose of avoiding tax. A very famous example is Vodafone case and its related amendment in section 9, and the laws relating to royalty, the definition of royalty, which got amended with a retrospective effect. So these are all some of the famous retrospective amendments which was done as a part of the third limb. So either of these three objectives should be satisfied in order for a retrospective amendment to stand still in the eyes of law. Just to summarize, there were plenty of rulings on this, whether a retrospective amendment is valid or not. Just to summarize, what is doable, what is not doable. What is not doable is overruling a judicial decision by a mere amendment in legislature. Now, a particular mention needs to be made. In recent years, it has been a practice or a fashion wherein in the finance bill there has been a couple of decisions, court decisions, which have been mentioned and which are being overruled because that is not saying that it is not the intent of the legislature. A famous example would be amendment in section 32 overruling the Supreme Court's decision in the case of Smith Securities. Similarly, there were a lot of amendments which were done in the recent past overruling certain decisions. Say there were Bombay High Court rulings and Delhi High Court ruling in the context of claiming cess to be a deductible expenditure, and it was being retrospectively amended in the finance bill to say that cess is also included as a part of tax and therefore not deductible. So therefore, can such judicial decisions, can such high court decisions or a Supreme Court decision be overruled? No, it cannot be just like that overruled by a mere amendment in the legislature. Then how can they overrule? So is that not something which is invalid in the eyes of law? No. So here comes the principles which are being upheld in various courts, even in the before the Supreme Court, wherein they say that yes, it can be overruled, but only by enacting a valid law on the topic. That too, it should be within the legislative field, and it should be fundamentally altering or changing its character retrospectively. So if suppose the underlying provision itself is amended without just overruling the judgment, if the underlying provision itself is amended and if it is within its legislative field and it's for the one of the objectives that the committee has recommended, then yes, retrospective amendment will hold waters in the eyes of law. So this is about the status of the retrospective amendment. Just to summarize, whenever you see a retrospective amendment in the upcoming finance bill, think through if whether that retrospective amendment is valid or not. It will be valid if it is within the legislative field. If it is going to overrule a particular decision, then it will be valid if it is going to enact a valid law within the legislative field. But otherwise, a retrospective amendment will be valid if it satisfies one of the three objectives: one, to correct apparent mistakes; two, to clarify something; three, to protect the tax base from highly abusive tax planning schemes. So when you see the retrospective amendment in the upcoming finance bill, think through these aspects, then decide the validity. Now we are moving on to the next thing, the next document. So till now we have been seeing through the finance bill, the effective date, the date on which it comes into force, all these things. And there is a little more that we need to deal with on the effective date part, which we will discuss now. And now we are moving on to the next document, which is as a part of the set of budget documents, which is Memorandum to Finance Bill. The first question that arises is, should I read the Memorandum to Finance Bill? Yes, you need to read it. It is a part of budget document, and it gives a very good or a very useful it acts like a very useful interpretation aid to the finance bill, and it is even recognized as an external aid in interpretation in various rulings, which we are going to see through now. And it provides a background and context in which the amendment is passed. Say, for example, if you take section 269 SS, you can read through the Memorandum to Finance Bill and understand in which context it has been introduced. if you see through, say, section 115O, then only when you read the memorandum to finance bill, you will be able to understand the various changes that that has been introduced in section 115O, introducing 115O, then again omitting it, then again reintroducing it. All these things needs to be read through with the context and the background in which all these things were done by the government in the previous years. So the memorandum to finance bill is very important interpretation aid. Now coming to the rulings. So has the court held that the memorandum to finance bill can be referred? Yes, there are several rulings in that context. Say, for example, we can take Jabalpur Bench of Income Tax Appellate Tribunal's ruling in the case of bromide chemical industries. This is a very recent ruling wherein the amendment to section 43B, which is there to the left of your screen, which was brought in as a part of Finance Act 2021. So here it says that if you read the explanation, it says, for the removal of doubts, it is hereby clarified that the provisions of this section shall not apply and shall be deemed to have never applied to a sum received by the assessee from his employees to which the provisions of section 224(10) applies, which is nothing but they are referring to the employee's contribution towards PF or ESI or whatever social welfare schemes it is. So employees' contribution is not going to be subjected to section 43B. There is a separate provision which is covering that. So that is what they are clarifying as a part of explanation 5. Now, if you see through carefully, here there is no effective date that is given in the provision in the Finance Act. Now the question arises. I am just referring to the previous screenshots that we read through. Here, if you see in the first screenshot, it says it with effect from the first day of July 2023. If you see the second screenshot, it says with effect from the first day of April 2005. But there is no specific mention here. Now the question arises as to from which date this provision is applicable. Is it retrospectively applicable just because it is called as an explanation? And the Parthasharthi Shom committee has already approved that the retrospective amendment can be clarificatory in nature, and this explanation is to clarify the provisions. Should that be read in that context? No. So how the ITAT has interpreted is, you go to the memorandum to finance bill. So has the memorandum to finance bill mentioned any effective date for this provision? In this case, yes. So here it says, if you see to the right hand side of your screen, that is the extract from the memorandum to the finance bill. It says these amendments will take effect from 1st April 2021 and it will accordingly apply to assessment year 2021-22 and subsequent assessment years. So the memorandum to finance bill is very clear about the effective date. So one question might arise, the finance bill is silent. Can I refer to memorandum to finance bill? Yes, it is approved by the tribunals, by various courts, not only by the Jabalpur ITAT. There are various rulings even in the other context by the Bangalore ITAT, even in the same context by the Bangalore ITAT and other tribunals. Now let's move on to one other ruling, Principal CIT versus Era Infrastructure India Limited. So here the subject matter of litigation was about an amendment in section 14A that was brought in by Finance Bill 2022. Here also, if you see the wordings that is used, it says explanation for the removal of doubts. It is hereby clarified that notwithstanding anything to the contrary contained in this act, the provisions of this section shall apply and shall be deemed to have always applied in the case where the income not forming part of the total income under this act has not accrued or arisen, has not been received during the previous year relevant to an assessment year, and the expenditure has not been incurred during the said previous year in relation to such income not forming part of the total income. There is no mention about the effective date from which this explanation is going to be effective. Now, what is the solution? Again, so here the court has referred to, it's before Delhi High Court, and the Delhi High Court has referred to the memorandum to finance bill. So here the department pleaded for a retrospective effect application in respect of this particular provision, but they failed. And retrospectively is set at naught in the judgment, and this was dated July 2022. This was pronounced by the Delhi High Court. And an interesting point to note here is the assessee didn't represent in the appeal from their side. So no one represented the assessee, but still the court held it in favor of the assessee, saying they need to refer to the notes on clauses and the memorandum explaining the provisions of the finance bill. So they refer to the memorandum explaining the provisions to finance bill 2022, and there the effective date was mentioned, and the Supreme Court rulings which upheld the validity of referring to the memorandum to the finance bill was also referred, and thereby the Delhi High Court held that this is not retrospective. So whenever you see the effective date being blank, or there is no mention about effective date, don't stop there. Go refer to the memorandum to finance bill and find out the effective date of that particular provision. Now going to the next ruling, CIT versus Vatika Township Private Limited. Here in this ruling, the proviso to section 113, that was the subject matter of litigation which was inserted by Finance Bill 2002 with effect from 1/6/2002. That was to impose surcharge and cess assessments. Again, here also the question was whether to read through the purpose of enactment of this particular enactment with the help of memorandum to finance bill. So here also the court has upheld that yes, the background and the context in which the sections needs to be interpreted, it that can be referred to the memorandum to the finance bill for the purpose of a better understanding. And this is a very famous case, Supreme Court, in the case of KP Varghese versus income tax officer. Here the principle is mentioned, which says that rule of construction of statute mandates to know the intention of the legislators in enactment of law, and hence the intention of legislators plays a pivotal role in the interpreting a statute. And where does that intention of the legislature is evident? It is evident from the memorandum to finance bill, which is one of the documents of the budget. Now, before moving on to the other thing, the next topic, just to summarize whatever we discussed on the memorandum to finance bill, is that a document to be noted? Yes, a big yes. Yes, it needs to be referred to, and if the effective date of a particular provision is not given in the finance bill, do go refer to the memorandum to the finance bill, and there you can find the date. And that is also something which can be used, and the courts have upheld it. Now going to the next topic, next issue as such, which is budget speech. This is also one of the documents of the budget set. Now the question arises as to, can I refer to the budget speech? Is that a reliable evidence, or can I place reliance on the budget speech? That is the question. Just like how we referred to the memorandum to finance bill, budget speech is also a document which can be relied upon, and this has been held in several cases, a few of which is mentioned before you. Supreme Court in the case of Loka Shikshana Trust versus CIT, this was a 1975 case, and in this case the context was about interpreting section 2 subsection 15, which was about the objects of a charitable trust, charitable nature. So the terminology of charitable or religious purposes, so that has been interpreted. So wherein the Supreme Court held that you need to refer to the finance minister's speech in order to understand the object and the purpose for which this amendment was brought in, this section was brought in, and therefore in light of the finance minister's speech, this section has to be interpreted. That's how the Supreme Court upheld. The other three rulings are also Supreme Court rulings: Indian Chamber of Commerce, Swat Art Silk Cloth Manufacturers Association, KP Varghese. In all these rulings, the Supreme Court has referred to the finance minister's speech, and therefore finance minister's speech is a well sought after document which can be referred and relied upon for the purpose of interpretation of any provision. Now the question might arise, so is it like an unfettered right that we have to refer to the finance minister's speech for any kind of interpretational issues that we have in the section? No, it's not like that. It's with limits. And what is the limitation that we have while relying on the budget speech? So this is very well interestingly brought out in these two rulings, these two Supreme Court rulings. The first Supreme Court ruling being Arkavi Spinning Mills Private Limited, wherein the Supreme Court mentioned that budget speech is an external aid of interpretation. We don't deny that. But it can be referred only when the law is unclear and very much confusing and ambiguous. Only in that case you can refer to the finance minister's speech, and not when the law itself is clear and unambiguous. So therefore, the first thing that you need to note is read through the provision, check whether it is clear. If it is unclear, then think about relying on the budget speech and not directly going to the budget speech for the purpose of interpretation of the provision. A same or a similar kind of an interpretation or a principle was brought out in the case of Anand G. Haridas and Co. Private Limited versus Engineering Mazdoor Sangh. This was a Supreme Court ruling wherein the apex court upheld that as a general principle of interpretation, where the words of a statute are plain, precise, unambiguous, the intention of the legislature is to be gathered from the language of the statute itself. No external evidence such as parliamentary debates, reports on the committees of legislature, or even the statement made by the finance minister on the introduction of the measure or by the framers of the act is admissible to construe those words. So, only when the words of a particular provision are confusing or it is not clear, then you have a recourse to the budget speech, to the finance minister's speech, and not in all cases. So, just to summarize, budget speech is an external aid to interpretation. You can refer to that, but it is with some limitations. Only if the provisions are ambiguous, then you have a right to refer or right to rely upon the budget speech, and not in every time. Let's go to the miscellaneous points that you need to note from the finance bill. The first being ambiguity in language. So if you see the words deemed to have always been applied, say for example, if you can see this in the provisions of section 3615A, in the amendment to section 43B in 14A, we can also refer to this screenshot here. So here if you see, it says shall not apply and shall be deemed never to have been applied. So this wordings, if you see, then it means that it is something ambiguous, and therefore you will get a right to refer to the budget speech, to the finance minister's speech, to the memorandum explaining the provisions of the finance bill. So look out for that ambiguous language. So if you find any, then you have an unfettered right to refer to those documents. But if the provisions are clear, you cannot refer to the external aids in interpretation. You are required to read through the provisions literally with whatever wordings that are used in the provision. The second thing is constitutional validity of an amendment. So whenever you go through an amendment, think and analyze whether it is constitutionally valid. Whenever we speak about constitutional validity, and if you go through the rulings that have been upheld in the past, then the most referred articles of the Indian Constitution are Article 14 and Article 265. Article 14 is about right to equality. Say, for example, Section 269 SS was questioned for its constitutional validity, saying 269 SS of the Income Tax Act is something which penalizes only the borrowers and not the lenders as such. And therefore, it questions the right of equality which every Indian citizen has. Therefore, it was questioned under Article 14 of the Indian Constitution, but the Supreme Court said that no, it is constitutionally valid for a reason that whether the obligation is on the borrower or the lender is the subject matter of decision by the CBDT or the government as such, and not something which is questionable under Article 14. But most of the cases which you see through in the context of constitutional validity goes has its reference to Article 14. Similarly, Article 265, when the taxes are levied, so Article 265 says taxes cannot be levied unless and until it is authorized by the legislation. So if you don't have a proper legislation but still the government levies tax, then Article 265 is something which can be invoked. So these two articles needs to be read through. This should be in your mind whenever you think about the constitutional validity of an amendment. Then the next thing, very famous, Finance Bill versus Finance Act. So there will be a couple of amendments in Finance Bill, but you cannot find it in Finance Act. So is that something which is valid? Yes, very well valid. That cannot be questioned. But just that When you have it in finance bill, you will have the external aids in interpretation, which includes memorandum and the other documents, finance minister speech and all. But when it goes directly into the finance act, then it doesn't have the external aids in interpretation. That is the only thing. Then look out for CBDT circulars, press notes, etc., and the impact on the judicial proceedings. So all these things needs to be kept in mind whenever you see through the budget, right from the beginning, right from the effective date of the finance bill, right from the effective date of each of the provisions contained in the finance bill. And if there is no date specified, then what should you do? Does it have an impact on the judicial proceedings? Does it have any impact on the constitutionality? Does it have any impact on the fundamental rights to a citizen? Does it have any ambiguous language in it? Should we have our recourse to the external aids? So all these things needs to be borne in mind whenever you read through a finance bill. And don't forget, you also need to read through the memorandum as well as the finance minister's speech. Now,
Uh,
summary. So as an auditor,
as
what you need to do?
Sorry to disturb you, as the time is 6:01. Please sit.
Yes. So as an auditor, what do you need to do? Read through the budget documents. Remember the principles of interpretation, whatever we discussed today, and then ascertain the impact. So, as a concluding remark, I would like to refer to John Baptist Colbert's statement, which says the art of taxation consists of so plucking the goose as to obtain the largest amount of feathers with the smallest amount of hissing. So, with all those interesting things coming up in taxation, in tax arena, let's have our fingers crossed for the budget 2024. Hope the today's session would have been insightful for you, and thanks all for joining, and thank you ICA for giving me this wonderful opportunity to present a session.
Thanks, Abhinaya, for your depth knowledge of the budget and good deliberation on the subjects. And on behalf of committee, Women and Young Committee, we thank you for your sparing your valuable time for the webinar. Thank you.
Thank you.
Thank you.